What if I told you that one of America's most powerful companies collapsed within just a few months? Not because it forgot how to make money, but because it stopped telling the truth. Enron was once called one of the world's most innovative and respected companies in business history. Politicians trusted it. Investors admired it. Employees believed in it. And Wall Street treated it as a role model. Then, in 2001, everything came to an end. Billions of dollars disappeared. Thousands of employees lost their jobs, and their retirement savings vanished. Trust in corporate America was shaken forever. So how did Enron rise so high and then fall in such a devastating way? This is the true story of the Enron Scandal. One of the biggest corporate collapses in history, the birth of Enron. Enron was created in 1985 through the merger of two natural gas pipeline companies. One was called Houston Natural Gas, and the other was Internorth. The key figure behind this merger was Kenneth Lay, who later became Enron's CEO. In the beginning, Enron was a traditional energy company. Its main business was transporting natural gas through pipelines and selling it to utility companies. This was a stable and heavily regulated business. But during the 1990s, everything started to change. Deregulation and a new vision results. During the 1990s in the United States, the energy market was deregulated. This meant the government removed strict controls on energy companies. Kenneth Lay saw a huge opportunity in this new system. Enron no longer wanted to just sell energy. It wanted to become an energy trading company. Just like Wall Street trades stocks, Enron started buying and selling future energy contracts and betting on price movements. At that time, this idea was revolutionary, and investors loved it. The rise of a corporate superstar results to turn this vision into reality. Enron hired Jeffrey Skilling, a former consultant from McKinsey. Skilling introduced a new accounting system known as Mark II market accounting. Under this method, Enron could record future expected profits immediately as current income, even if the actual cash was never received. On paper, Enron looked extremely profitable. In reality, many of these profits were only estimates. Still, Wall Street was impressed, and Enron's stock price skyrocketed. By the year 2000, the company's value exceeded $60 billion. Fortune magazine named Enron America's most innovative company for 6 consecutive years. The culture inside Enron, the corporate culture, was extremely aggressive. Every year, employees were ranked against one another. Those who ranked at the bottom were fired. This system was known as rank and yank. This pressure created a dangerous mindset. Profits had to be shown at any cost. Ethics were pushed aside. Results became everything. Hiding the losses result. Not all of Enron's projects were successful. In fact, many projects were losing massive amounts of money instead of reporting these losses honestly. Enron executives searched for ways to hide the debt. This is where special purpose entities were used. These were separate legal companies. Through these entities, Enron moved its debt off the balance sheet. Some of the most famous entities were called LJM and Chuco. Shockingly, these entities were controlled by Enron's own CFO, Andrew Fastow. This was a clear conflict of interest, but it allowed Enron to appear financially strong. Even though the reality was very different, the role of Arthur Andersen results Enron's auditing firm was Arthur Andersen, one of the most respected accounting firms in the world at that time. Arthur Andersen approved Enron's accounting practices and also earned huge consulting fees from Enron. This created another major conflict of interest. When investigations began, important Enron-related documents were destroyed. This decision eventually led to the collapse of Arthur Andersen itself. Warning signs ignored results. Some analysts and journalists started raising serious questions. Enron's financial statements were extremely complex. Very few people truly understood how the company was actually making money. But as long as the stock price kept rising, these warnings were ignored. Employees were encouraged to invest their retirement savings in Enron stock. Meanwhile, top execs quietly sold their own shares. The collapse begins. Result in 2001. The truth began to surface. Enron announced massive losses and admitted it had hidden billions of dollars in debt. Credit rating agencies downgraded Enron to junk status. Investors panicked. A stock that once traded above $90 collapsed to less than $1. On December 2nd, 2001, Enron officially filed for bankruptcy, the largest bankruptcy in U.S. history. At that time, the human cost results: more than 20,000 employees lost their jobs. Many people lost their life savings because their retirement funds were invested in Enron stock. Executives walked away with millions. Employees walked away with nothing. This damage was not only financial, it was emotional and psychological as well. Legal consequences result. Several top executives faced criminal charges. Andrew Fastow was sent to prison for fraud. Jeffrey Skilling was convicted on multiple counts. Kenneth Lay died before sentencing. Arthur Andersen was convicted of obstruction of justice. This verdict effectively destroyed one of the world's oldest accounting firms. Impact on the financial world results: the Enron Scandal shook the entire corporate system. In 2002, the Sarbanes-Oxley Act was introduced. This law strengthened financial transparency rules. Executive accountability increased, and investor protection became a priority. Lessons from Enron. Results: the Enron Scandal teaches us several powerful lessons. Innovation without ethics is extremely dangerous. Complex systems can hide massive risks. Transparency matters. Corporate culture shapes decisions. Blind trust can be very costly. Enron did not collapse because of bad ideas. It collapsed because it abandoned the truth. Conclusion: result: Enron's rise was built on confidence, innovation, and power. Its fall was caused by greed, deception, and lack of accountability. This is not just the story of one company. It is a warning. Because when truth is hidden, even the biggest giants eventually fall.
If you like this video, please like the video and subscribe to the channel. See you in the next video. Bye for now.